China's recent gold grab has been welcomed by private investors of the precious metal, but it sent shudders through the commodities markets. Analysts say it's another sign the Chinese economy is in trouble. Industry leaders say until more gold bulls step in, Australia's producers will continue to suffer from the 4-year now bear market. But as David Taylor supports, there is one obvious silver bullet for the gold sector and the broader Australian economy.
It's been one of the best kept secrets on global markets. Just how much gold is China holding? Well, for the first time since 2009, the veil has been lifted.
A massively influential central bank, the biggest central bank in the emerging world, has come out and as a buyer of gold.
It's been revealed that China's reserves of the precious metal have been boosted by 604 tonnes, or a massive 57%. The market has been void of heavyweight bidders for many years. Since late 2011, the price of gold has plummeted over 70%. Record low interest rates have been deployed around the world to ward off the threat of deflation, which is kryptonite for gold bulls. But analysts say China's latest dive into the market could mark the end of gold's breathtaking 4-year bear market.
To me, the main message from that is that they will continue to buy for many years to come, and that will provide some sort of support to the gold market.
Deep underground in ABC Bullion's secure vaults, the company stores millions of dollars worth of gold and silver for its clients. Those clients have welcomed China's latest play.
Short term, they're obviously trying to appease the IMF in terms of getting the yuan included in the SDR. As I say, they will be a buyer in the market for years to come, as will citizens in their country.
But China's renewed interest in gold has raised alarm bells about the health of the world's second biggest economy. Analysts say China's suffering from a debt binge hangover, helped along by low interest rates. Its recent share market crash has also seen many foreign investors head for the hills. Goldman Sachs analysts estimate that foreign capital outflows topped $224 billion in the second quarter, a level beyond anything seen historically.
Money is moving out of commodity ETFs towards more hot markets, and the hot markets up to recently was the Chinese stock market and other global equity markets. So it remains to be seen what's hot next.
As Chinese financial markets rapidly cool, Beijing's come under fire for not doing enough.
I am quite concerned about China. I'm not one of these China bulls. I think the government has a real problem on its hands.
Australian gold miners have so far been insulated from the falling bullion price.
Our natural floor is probably around about 1,300 Australian dollars an ounce, and the current spot price is sitting at around about $1,500 an ounce. So that's a fair bit of a margin still to play with before you get to that point where your business gets a little bit uncomfortable.
But until the price of gold turns, producers remain worried about the future.
There's also, the haves and the have-nots in the sector at the moment. You've got the companies like the Northern Stars, the Evolutions of the world, the Newcrests that have those size balance sheets that can do exploration, but you go down the junior end and a lot of them don't have the money to do it.
Australia is the second biggest gold miner in the world. Economists say any damage to the sector is a blow to the economy. In fact, the precious metal is worth around 0.5 to 1% of GDP.
If you're a person that's wanting to see better growth and better employment and better wage growth in Australia, then a healthy gold mining and healthy gold sector is good for our country.
And the silver bullet for that could be an Australian dollar below 70 US cents.